Welcome back, focused learners, to another deep dive explainer. Today we're breaking down a fascinating, really comprehensive stock analysis of Air Products, sourced directly from Save Invest Compound. We're going to look under the hood of an absolute industrial giant, examining a core tension that makes this company such an incredible case study right now. Seriously, on one hand, we've got a highly stable, incredibly durable core business. But then, it's colliding head-on with some massively expensive capital allocation missteps on the other. It's kind of like watching a perfectly reliable freight train suddenly decide to try and fly. So let's get into the story of fantastic moats and, well, questionable management decisions.
Okay, let's dive into this. $2.9 billion. Yeah, you heard that right. That is the massive pre-tax write-off Air Products recently took just to exit a speculative blue hydrogen complex down in Louisiana. And actually, it's this exact write-off that triggered the entire financial analysis we're exploring today. Because think about it, when a company essentially torches nearly $3 billion in capital, it really begs the question, is the underlying engine actually strong enough to survive the crash? And more importantly for us, is the stock still worth buying?
To figure that out, here's our roadmap for this explainer. First, the core business understood. Second, financial health and cash flow. Third, valuing the moat. Fourth, assessing risks and rewards. And finally, our final verdict and disclaimer.
Let's start with Section 1, the core business understood.
Now, what's really interesting about this slide is the sheer contrast within the company's own operations. To evaluate the stock, we have to unpack exactly how Air Products makes its money day in and day out. On one side, you have the core industrial gas trade. We're talking oxygen, nitrogen, argon. This business is beautifully boring. It operates on these 15 to 20-year take-or-pay contracts. Basically, that means customers guarantee a minimum payment whether they actually take the gas or not, which heavily cushions the company against economic cycles. But then, on the flip side, we see management's recent obsession: clean energy megaprojects. These are highly speculative, totally unhedged, high-risk capital allocations, exactly like that Louisiana project they just wrote off, or the massive NEOM green hydrogen project over in Saudi Arabia.
So why is that base gas business so incredibly stable? Well, it comes down to market structure. The industrial gas industry is a global oligopoly. Air Products, right alongside Linde and Air Liquide, just completely dominate it. And the reason why is this massively wide economic moat. See, Air Products literally builds its plants physically on-site right next door to the customer's facility. The switching costs are astronomically high. You don't just easily swap out a supplier whose multi-million-dollar infrastructure is literally bolted into your supply chain on an exclusive 2-decade contract. Add in the route density advantages for the delivery trucks, and you've got yourself a pricing power fortress.
Moving right along to Section 2, financial health and cash flow.
I have to warn you, though, despite that beautiful economic moat we just talked about, this brilliantly illustrates the single biggest weakness of the company today. The free cash flow trend here isn't just one bad quarter. It is a 4-year bleed. We're looking at negative $1.42 billion in fiscal 2023, negative $3.15 billion in 2024, and then plummeting to a staggering negative $3.77 billion in fiscal 2025. This alarming trend was driven by peak capital expenditures that got near $7 billion in 2025, mostly as the company just funneled cash straight into those speculative megaprojects. So the core business is definitely generating cash, but management's aggressive growth ambitions have been burning it way faster than it comes in.
So how does all this cash burn impact the broader balance sheet? Well, a debt-to-equity ratio of 1.06 is technically fine for an industrial company, but it's the sheer velocity of that debt that should really make you sweat. Leverage has shot up 5-fold in dollar terms since fiscal 2021, entirely to fund these megaprojects. And that multi-billion-dollar write-off we mentioned earlier, it actually swung their operating margin to a negative 7.3% in 2025 before it started to recover. But honestly, perhaps the most damning metric for shareholders right now is the return on invested capital. It fell from 9% down to roughly 6.5%. When your ROIC falls that low, the company is earning dangerously close to its cost of capital on new investments. They are essentially destroying shareholder value in a blind pursuit of growth.
All right, Section 3, valuing the moat.
Now, this brings us to the absolutely critical question for any value investor. Knowing the incredible strengths of those contracts, but also the glaring weaknesses of the cash flow, what is this business actually worth today? Well, the intrinsic value math is pretty sobering. The discounted cash flow point estimate, the fair value, sits right at around $230 per share, but the current share price at the time of this analysis, it's hovering roughly around $297. This means the stock is trading with a negative 24% margin of safety.
At $297, the market is already pricing in a flawless, squeaky clean recovery. The market is basically assuming the new capital discipline works perfectly and zero future mistakes are made. And as an investor, paying for perfection is a highly, highly risky game.
To put this into a strict portfolio strategy perspective, the source ran the numbers on exactly what you'd need to pay today to achieve a 9% annual return. If you've got a 16-year holding period in mind, a disciplined value investor really must wait for the price to drop all the way down to around $154 a share to confidently lock in that 9% annualized gain. Even on a much shorter 5-year horizon, the target buy price is only $209. In pretty much every scenario, the current price of nearly $300 is just way too rich for a value investor seeking any sort of real margin of safety.
Let's break down Section 4, Assessing Risks and Rewards.
So the crucial point is weighing all these moving parts. A SWOT analysis brings things into really sharp focus here. The strengths are absolutely undeniable. A 40-plus year track record of dividend growth, and that fortress-like oligopoly moat. The opportunity is also very real, especially with the new CEO, Eduardo Menezes, stepping in, instituting some much-needed capital discipline, and guiding a falling capex glide path down to roughly $4 billion for 2026. But we have to counterweight those heavily against the weaknesses and threats. 4 consecutive years of negative free cash flow is a massive red flag. And looking ahead, there are very real threats of multi-year falling helium prices squeezing their margins, plus the terrifying prospect of further write-offs if projects like NEOM suffer the exact same fate as Louisiana.
Now, in value investing, you always have to seek out the disconfirming evidence, right? You have to look at the bear case that challenges your assumptions. And here, the bear case is loud. Yes, you have a genuinely strong core gas business, for sure, but it is trading at 31 times trailing earnings. Paying a 31 multiple for a company that has literally burned billions in cash over 4 consecutive years, just wrote off nearly $3 billion on a single failed project, and increased its leverage 5-fold, that is a very dangerous entry point. The promised capex reduction to $4 billion in FY26 is a great catalyst, but the current rich valuation leaves absolutely zero room for error.
Finally, Section 5, Final Verdict and Disclaimer.
Our snapshot verdict from this entire analysis is a definitive hold. Look, Air Products is a great business, but it's currently trading at a bad price. If we use legendary investor frameworks here, the core gas operations perfectly fulfill Peter Lynch's definition of a stalwart. It's a reliable, mature franchise. However, because it's priced for absolute perfection right now, it completely fails Charlie Munger's strict margin of safety test. If you want a reasonable long-term entry, wait for a pullback to the 220 to 240 range. But if you demand a strong margin of safety, you've got to have the discipline to wait for $154. Until then, you hold.
Now, I need to pause the narrative flow for just a second to strictly read this reminder. This analysis is for informational purposes only and does not constitute investment advice. Always perform your own due diligence or consult with the financial advisor before making investment decisions.
And with that, we wrap up our deep dive into Air Products. It's an incredible reminder that a great castle can easily be compromised if the king mismanages the treasury. It really leaves us with a critical question to ponder. In this age of green energy transitions, how many other industrial giants are quietly burning their moats just to chase the future? Let me know your thoughts. And hey, which stock or industry should we break down in our next explainer? Drop your requests in the comments below. Keep learning, stay disciplined, and I'll catch you in the next one.